like she mentioned, today's presentation is focused on the review of red flags of fraud in the workplace. So I'll start with a little bit about myself. As mentioned, my name is Taylor Rote. I'm a supervisor for Smith Elliott Kearns & Company, and I work in the Chambersburg office. I'm a CPA, and I received my master's in the science of accountancy from the University of North Carolina, Wilmington. I stayed down in Wilmington for about 3 years at a global firm and then worked my way back up to Pennsylvania, and I've been with SEK now for a little over 3 years as well. So I work within our audit department and primarily work on local governments, mainly consisting of townships, municipal authorities, boroughs, and school districts. So today's webinar will consist of a quick review of what is known as the fraud triangle, and then I'll move on to some potential red flags of fraud in the workplace, and then spend the majority of the session on case studies of specific fraud schemes in local governments and how they could have possibly been prevented. So I also have just a few polling questions here on the front end of the webinar for a little interaction, since I can't see anyone's face on my end. So for our first polling question here, if we could pull that up, and this is completely anonymous, so I'm just curious how many participants have actually encountered, suspected, or even just heard of any prior stories of actual or attempted fraudulent activity, whether in your current work environment or a previous work environment. So you can answer A for yes or B for no. Now, obviously, I'm not implying anyone here has committed a fraudulent act of any sort, but again, I'm just curious how many people have been around it in their careers. So I'll give everyone a minute to answer.
Okay, we have the majority of votes in.
Okay. Great and good. So the majority have said no. Some have said yes, unfortunately. So as a part of, I'll mention as a part of our audits, we do ask the question of if anyone within our clients have suspected fraud or know of any fraud. Typically, thankfully, the answer is usually no. Sometimes we do get a yes, and they're usually pretty minor cases. As a part of our audit, it isn't the purpose. We're not in there for a fraud investigation, but it does come up sometimes. So again, just kind of wanted to get a feel of from the participants how many have seen it in their experience. Okay, so I'm going to start by going over what is known as the fraud triangle. So the fraud triangle is a model that was developed by criminologist David Cressy, and it states that there are essentially 3 factors that need to be present for fraud to potentially take place. So Cressy, in his own words, stated that trusted persons become trust violators when they conceive themselves as having a financial problem, which is non-shareable, are aware this problem can be secretly resolved by violation of the position of financial trust, and are able to apply their own conduct in that situation, verbalizations which enable them to adjust their conceptions of themselves as trusted persons with their conceptions of themselves as users of the entrusted funds or property. So that was a lot, but in layman's terms, essentially Cressy was saying that in order for fraud to occur, 3 elements must be present. These elements include pressure, which can be either internal or external, opportunity to commit the fraudulent act, and then rationalization of why it was morally right or acceptable to commit the fraud. So to further dive into these components, I'll start with the first element, which is pressure and incentive. So the pressure to commit fraud can arise from a number of different situations. Perhaps the employee is in a bad situation financially from significant loans, credit card debt, or medical bills. On the other hand, the employee might like to lead a lavish lifestyle and needs to support an expensive habit or an addiction, but not have the means to do so. So this can be further heightened by the public pressure of reaching a certain status. Caring about the way a person is perceived by others gives them the incentive to better themselves, which can be done through fraudulent acts. Employees may also feel internal pressures from their employer that would drive them to commit fraud. So if an employee feels overworked, underpaid, or underappreciated, they may have adverse feelings toward the organization and therefore be more enticed to steal or misappropriate assets. An employee could also become aware of future layoffs and take the opportunity, which we'll discuss next, to take what they feel they deserve. Okay, so with these pressures, an individual may then seek out opportunities to commit fraud. So one thing to note about this element of the fraud triangle is that this is the area that the organization actually has the most control over. So for an example, an employee may seek out an area of the operation that lends itself to theft or misappropriation, excuse me. If the organization accepts or keeps cash payments, this presents obviously a much larger opportunity than if receipts were accepted via credit card or check. Similarly, a high level of inventory on hand presents the opportunity of theft. Other operating characteristics that would present potential opportunities include rapid turnover of employees, which would result in one person taking over multiple roles. And then if your entity tends to operate in crisis mode, so with little time for supervision or review. Another opportunity then for an employee within an organization is the level of trust in that individual. So you'll see in some of the cases that we'll go over, the majority of the more significant fraud cases were perpetrated by someone high up in the organization or someone who had a long standing with the operation and was liked by everyone. So obviously no one wants to believe that their coworkers or superiors would steal and lie, but that doesn't mean it doesn't happen. More importantly, it can happen at all levels. So trust is important to maintain good relationships and implement a strong company culture. However, it needs to be supplemented with professional skepticism and the ability to identify red flags, which we'll go over a little later in the presentation. So finally, and maybe most importantly, we'll talk about internal control issues. If your organization does not have the proper internal controls in place, this could present a multitude of opportunities of fraud. So by far, I'd say the largest internal control issue we see as auditors, specifically in small entities, is a lack of segregation of duties. So with limited staff, this can sometimes be difficult to do, but it is imperative. You'll see why in some of the case studies later. Other internal control issues leading to opportunities of fraud may include the absence of mandatory vacations and then the failure to enforce ethical standards within your staff. All right, so then on to the third component, and this is the attitude that the individual has towards committing the fraudulent acts and how they are able to rationalize it as acceptable behavior. So all of the components are interconnected, but this really goes back to any pressures the employee is feeling and how easy it was or the opportunities available for them to commit the fraud. For example, if the organization has that large amount of cash or inventory on hand, the employee may rationalize by saying, well, I was only borrowing it and it will be replaced later on, or that with all the resources the entity has, what was taken wouldn't go noticed or wouldn't even be missed. Another example would be if a disgruntled employee feels overworked or underpaid, they may feel that they are deserving of more and that they are just taking what is owed to them essentially. So those are the three quickly components of the fraud triangle. Now I'll move on to another polling question here. So polling question 2, of the three components of the fraud triangle, which is the only piece that can be controlled by the organization? I'm going to pull that up for everyone to be able to answer. I'll give you a few minutes here.
Okay, we'll go ahead and close that now.
Okay. And great, everyone, yeah, got it right. Yes, so B, the answer is opportunity. So although some things are out of control of the organization, presenting the opportunity of fraud can often be prevented by having adequate internal controls and a heightened level of awareness. All right, so before the case studies, I also wanted to touch on some ways that fraud can be identified and some specific signs or red flags to look out for. You'll see a lot of these examples show up in the actual fraud cases that I'll go over then at the end of the webinar here. So for starters, a huge red flag could be a shift in lifestyle with no corresponding change in income. So if the individual appears to be living beyond their means, making significant or luxury purchases, it may be an indication that they are involved in fraudulent activities. Changes in personality and behavior can also be potential red flags. So this includes if the employee is always at the office, specifically by themselves, if they appear to be on edge or uneasy around coworkers, not taking advantage of vacation or time off, or if they are presenting financial figures that either appear too good or too bad to be true. These could all be other indicators. Okay. There can also be red flags within the actual organization that would help to provide the opportunity to an individual to commit actual fraud. So as previously discussed, having too much trust in a key employee can lead to too much reliance on their word and the work that they're doing. In addition, if no clear expectations are set or there is no proper approval or adequate internal controls are not implemented within the organization, this can lend itself to fraud, I'll say, slipping through the cracks or potentially spanning years and years. Other red flags on the organization level include lack of attention to detail in any sort of review or supervisor role, a change in organization structures or significant turnover, and the tendency to work in crisis mode, which lends itself to some impulsive decisions as well as a lack of review. Okay, obviously another area to pay close attention to then is the actual financial records. So be aware or on the lookout for missing or altered documents, including bank statements and bank reconciliations and invoices. In addition, an excessive number of voided checks or checks out of sequence can indicate the tampering of the checkbook for personal use. As far as actual invoices, the vendor information could be manipulated to an employee or a relative's address or PO box. Some fraudsters also use fake addresses or phone numbers. And then finally, unusual or missing authorization of payments and receipts could indicate a lack of segregation of duties and that a person has full control of the billing or receipt process. Let's keep some cups of water here. Okay, so in connection with the previous red flags, an overall lack of internal controls presents the biggest opportunity for an employee and is one of the biggest red flags, specifically for auditors or fraud investigators. So more than anything, a lack of segregation of duties allows the most opportunity for fraudulent activity. If a single person is responsible for every aspect of a transaction, whether it be in the billing department where they are collecting the receipts and making the deposits, or within processing payments where they are setting up vendors, opening the invoices, signing the checks, and reconciling the bank statements, it allows for embezzlement to potentially go undetected. Other control issues include lack of physical security of financial information. So that could be either through actual locks and keys on doors or cash receipts drawers, or computer controls. Say if there is no password security or shared passwords, or if certain system restrictions are not activated. So also a relaxed management style with little to no oversight and inadequate training of staff can also subject an entity to the threats of fraudulent acts. So again, those were just some specific red flags that you can look out for in your own workplace. And now I'll jump into some actual fraud cases for the majority of the webinar here, in which there was typically a complete lack of internal control and too much trust in certain employees. So We'll see if we can pinpoint what the red flags were in each of these cases and how the fraud could have potentially been prevented or detected earlier than it was. Oh, and actually, we're gonna come back to that polling question after the first case here, so I'll come back to that then. So the first case I'll go over is one of the most significant fraud cases uncovered for a local government, and that is the embezzlement of almost $54 million by the Comptroller of the city of Dixon, Illinois, whose name is Rita Crenwell. So to put in perspective how damaging financially this was, the city itself only had an annual budget of around $6 to $8 million. So that being said, over the course of her scheme, which was around 22 years, she essentially stole half of what was budgeted for the city. And I'll go over the case at a high level, but I'll also mention there is a very interesting documentary called All the Queen's Horses that really dives into how she was able to pull this off for so long, and then the eventual aftermath from being caught. So for a little background on this, Rita was thought to be and should have been one of the most trusted people in the city's payroll. She started working for the finance department for the city while she was still in high school in 1970. And then 13 years later, in 1983, she was appointed as the comptroller and treasurer of the city. 7 years then after she was appointed to these positions, so in around 1990, she would begin her fraud scheme that again would span 22 years. So it's important to note Rita's personal life. Outside of work, her and her family showed horses professionally, which is a very expensive hobby. Not only that, but there's little to show financially for how much time and money is put into it. Her lavish lifestyle was also not hidden from the community. She was very out in the open about her horses and the stables and barns she had built and operated for them. And there were no questions about if she exuded wealth because she openly displayed it to everyone. So in addition to her award-winning horses, Rita also maintained multiple homes in Illinois and Florida, had a pretty extensive jewelry collection, and had multiple cars and various other assets to her name. So how did this happen? For the amount of money stolen and for the period it went undetected, it'd be assumed that this was some sort of extravagant and complicated plan that was put into place. In reality, that was not the case. So to simplify the whole scheme, this all was essentially done by Rita setting up a secret bank account and transferring money over from one of the city's legitimate bank accounts. So this secret account was set up in 1990 in the name of the city of Dixon. The account was established under the account name of the RSCDA-Reserve Fund, and that stood for the Reserve Sewer Capital Development Account. Now, for a municipality, the establishment of this account wouldn't necessarily raise any red flags to the bank, as it is typical for a capital reserve accounts to be set up for current or future projects. The problem lied in the fact that not only was she the only signer on the account, but she was also the only person within the city that even knew this account existed. Excuse me. So once this account was set up, Rita started the transfers. Funds coming into the city, mostly from sales tax and income taxes, would first go into a legitimate state account. And then once deposited into that account, Rita would call to transfer the money into a different legitimate capital development account within the city. So from there, she would manually write a check from the capital development account that was marked as payable to the treasurer, city of Dixon, and take it to the bank to deposit into that fraudulent RSCDA account. The scheme started relatively small, amounting to around $181,000 in the first year. So obviously most people wouldn't hear that figure and call that small theft, but by 2008, which was the height of the national financial crisis, I'll add, Rita had misappropriated $5.8 million in that year alone. So she did this same transaction 169 times until she had stolen almost $54 million from the city. So it's easy to listen to this story and say, how in the world did this happen? Again, it all goes back to the unconditional trust that was put into Rita. Unfortunately, trust is not an internal control. After the fraud was discovered, it was noted that city employees never suspected her, again, because they trusted her, and because the checks she was writing were made out to the treasurer, and then in parentheses or a dash in their general ledger book, she would put the state of Illinois. So anyone looking at the checkbook or the register, they just assumed that she was making payments to the state for the city's portion of capital projects that were being done. On the rare occasions that Rita was questioned about the financial shortfalls of the city, for which they did have some significant shortfalls, clearly with her stealing all this money, Rita would respond by saying that the state of Illinois was just late with payments to the city. So this excuse was relatively believable because the state sometimes was as much as a year late with certain reimbursements or tax payments. Rita's scheme then was finally uncovered by a city clerk in October of 2011. So one night Rita was out showing her horses at a competition, and the city clerk was frantically trying to get information together for an upcoming council meeting. Rita was the only one with access to the online banking and the only one that opened the statements that came into the mail. So in the event the clerk ever did need to reach out for account information, Rita instructed her to email the bank and request statements for only specific account numbers, obviously leaving out the RSCDA account. Because the clerk was in such a rush that night, however, she took it upon herself to call the bank and just requested them quickly to fax a statement of every account under the city's name, as opposed to typing out every individual account number. Much to her surprise, the statements were faxed and showed 3 large deposits totaling around $1 million into this unknown account. The clerk then took this information to the mayor and an investigation was underway. Rita would eventually plead guilty to a single count of wire fraud, and she was sentenced to almost 20 years in prison. She's still in prison, and I believe her release date is scheduled for around 2030. So although this fraud significantly impacted the city on a financial and emotional level, they were able to recover $40 million from a civil lawsuit against the city's 2 accounting firms, and the bank the accounts were maintained, and then also from the sale of Rita's assets. Okay, so what internal control procedures could have been put in place to prevent or detect this fraud? As I mentioned, a lot of this stemmed from the trust that was put into a single person. Having a heightened level of skepticism, being alert to potential red flags, and having a questioning mind is absolutely necessary. Based on Rita's role at the city, should she really have been able to support the lifestyle that she lived on her salary? Should the city really have been in the dire financial position it was? These are all relevant questions that should have been asked early on or further investigated. There was also clearly too much reliance on one person in the financial department of the city. So it's always a good control to require multiple signers on bank accounts. And typically a bank will require proof of board approval within the minutes of these signers before an account can even be established. Now, since there was a civil lawsuit against the bank, like I noted, whether the bank the city was using followed their own protocols, that may have been part of the issue there. Clearly, though, Rita had too much power, and there was an apparent lack of segregation of duties. In Dixon, Rita controlled too much, if not all, of the financial reporting process. So she was able to receive, sign, and deposit checks with little oversight from any other city official. She also balanced the checkbook, made deposits, and obtained all bank statements sent to the city mailbox, over which she had complete control. So with no one else involved in any of these processes, it was pretty easy for her to get away with the theft of the city funds. Additionally, then, more effective board oversight and again, questioning minds could have maybe prevented the magnitude of this fraud scheme. So reviewing monthly or annual budgeting reports may have indicated that something was out of the norm. Also, being more involved in the actual budgeting process would ensure that the budget put in place made logical sense for the funds to be received by the city and actual expected expenditures. There was also little to no oversight of her work specifically. So although Rita was in charge of reviewing transactions, no one was there to check what she was doing. Oftentimes, an organization will have some form of board review of monthly statements, as well as a set dollar threshold on specific expenses that need board approval. So it's hard to say if any of these may have actually prevented the initial fraud, but certainly had some of these controls been in place, the fraud would have been detected earlier than it was. All right, I'm going to scroll back to the last polling question then, which is, which of the following operational red flags presents one of the largest opportunities for an employee to commit fraud? Is it A, lack of segregation of duties, B, inadequate training, C, missing checks, or D, an employee working an excessive amount of overtime? Give you all a little bit of time to answer then.
Okay, we have the majority in.
All right. Thank you, Kathy. And yes, so the majority got that right. So A, lack of segregation of duties. And now this goes back to the red flags that we discussed earlier, and also was clearly one of the biggest operational red flags in the city of Dixon's case. So with Rita being the only signer on the accounts, the only person with any bank access altogether, and the only person even touching the reconciliations, there was a clear opportunity for her to embezzle a ridiculous amount of money from the city there. All right, skip forward then. Okay. So the next two fraud cases I'm going to review with you involve school districts. So although some of these examples are much higher scale and may deal with different transactions than those of townships or boroughs, we still felt it was beneficial to see what could and what has happened for you all to determine if it would be possible within your own organization, and if so, how it could be possibly prevented or detected early on. So I'll start with the case of Rosslyn School District, which involved the superintendent, Frank Tizone, and other employees within the district embezzling over $11 million in the span of 8 years from 1996 to 2004. So as I mentioned that there's a documentary on the Dixon fraud case I just went over, there's actually a motion picture that was made and is based on this story. It's fairly new, and it's a movie called Bad Education. I believe it's on HBO, but there's some pretty notable actors portraying the superintendent and assistant superintendent. Although it was probably exaggerated a little bit with certain storylines, just for cinematic effect, I'll say, it was definitely really interesting and entertaining to watch if any of you all are interested in that after kind of hearing the details of this case. So to set the stage for this case, Rosslyn School District is what was known as a prominent district located on Long Island, New York. The district had around 3,300 students, a 95% graduation rate, and a healthy number of students enrolled in Ivy League colleges upon graduation. So this was all thought to attribute to why the losses went undetected as long as they did. Residents in the community were more focused and prideful of their academic achievements as opposed to maybe any financial achievements or projects that were going on in the district. In addition, the superintendent, similar to Rita Crenwell, was well-liked and trusted. He was a charming personality and it impressed not only the school board, but also parents within the district. So in total, it was determined that the superintendent embezzled around $2.4 million of district funds, while the assistant superintendent at the time was responsible for around $4.6 million in unauthorized spending. In addition to them, Further criminal investigations led to grand larceny indictments of the district's business manager, the accounting clerks, and then other employees at the time. So this is important to note because typically when there's only one person involved in a fraudulent act, it's easier to see the areas of weakness or lack of controls that would have caused the fraud to happen. On the other hand, when there's collusion involved or when multiple people are working together for the financial gain, it is oftentimes much harder to detect. And that is because there may actually be a system of controls in place or a segregation of duties in place, but they're being manipulated by the people involved in the different phases of any one financial process. So as far as what these district employees were stealing, a New York Times article reported that expenses incurred by these employees ranged from a 65-cent bagel to a mortgage on an extravagant home in Florida. Other expenses included luxury cars, paying off relatives' student loans, jewelry, cash withdrawals, and then fake contracts with relatives and friends. With the degree of the expenses incurred, the means of the fraud scheme varied as well. So a forensic audit on this case concluded that some funds were obtained through fraudulent credit card use, some through falsifying salary reports to the state pension system, and then some even through the direct billing of personal expenses to taxpayers, which is kind of crazy. In addition, then, there were estimated to be over $1 million in contracts awarded to friends and family of the employees involved with no proven record of any return value received by the district. There also was almost $550,000 in funds that were obtained through unauthorized raises and bonuses to these employees involved. A notable discovery then, and one that is almost unbelievable to believe that they were able to get away with, was at one point the superintendent, who I'll say had 24 separate school credit cards. He averaged $700 in cash withdrawals per day for a period of 20 months. And then another report showed that the assistant superintendent, who had 23 of her own school credit cards, was averaging around $1,270 per day in cash withdrawals for a month in a certain year. So again, how that kind of splits through the cracks is beyond me. But to make matters worse, the district also had previously covered up an early warning of the full scheme at hand. So the assistant superintendent that I've been mentioning, she was actually caught years before the total fraud was uncovered, stealing $223,000. So again, it was later uncovered that she had stolen up to $4.6 million, but of that, $223,000 was actually proven by the district early on. In order to save face, though, and instead of further investigating the matter, the board allowed her to repay the money and leave quietly without any report to the public or pressing of any charges. Notably, this was done so on the advice of the attorney that was brought in by the superintendent. So I'm sure you can assume why he was suggesting to sweep that under the rug. So how does the remaining misappropriation of taxpayer funds go unnoticed for so long? An investigation into the district revealed that the financial software used by Rosslyn School District could be easily manipulated by the users of the software, and that it had a standard fraud control setting that had never been activated by the district. Essentially, what they could do was, after a check had been issued, the name of the payee could be changed in the accounting records to a legitimate vendor of the district in an attempt to conceal the fraudulent payment. So as an example, personal American Express charges totaled almost $1.5 million, and they were manipulated and paid under the vendor number for Sergeant Welch, which was the company that provided the district with lab supplies. Similarly then, payments to Citibank of around $900,000 were made under the vendor number of Nassau County Board of Cooperative Educational Services, which was the company that the district used to provide their special education programs. Further then, and in order to ward off any concerns of the board with any overexpended budget categories, the school officials involved were able to manually shift funds among different accounts. So once a certain budgeted expense line item was close to reaching its full budget for the year, they would reclassify those amounts to different line items. In addition, the superintendent had been granted unlimited and unrestricted authority by the board to make account transfers. So this authorization actually was made to him even though the New York State Education regulatory agencies require the board to set limits on the amounts that can be transferred without board approval. So that was definitely a misstep on the board's part there. The total fraud then was finally uncovered when an anonymous letter was mailed to officials prompting an investigation. So both the superintendent and the assistant superintendent were sentenced to different terms in prison for larceny, and they have either paid back or they are working to pay back what they stole. The movie then also specifically points out that due to an oversight in the New York State pension law, the superintendent is still able to collect almost $175,000 a year, and then the assistant superintendent is able to collect almost $55,000 a year of their pension for the rest of their lives. So even with all that fraud, that just kind of blew my mind that they were still able to collect on all of that. All right, so that's the case of the school district. What could have been done, though, to prevent this degree of fraud? So again, this one is a little more tricky as there was collusion between the employees, but clearly the tone at the top, which that refers to the ethical atmosphere created in a workplace by the organization's management, was not one of respect or morally correct behavior towards the district and its taxpayers. So the officials were acting strictly in a selfish manner, establishing and implementing a proper code of conduct. It is one of the most common anti-fraud controls used in organizations. However, if there is enough pressure, opportunity, and rationalization, going back to the fraud triangle we discussed, that may not be enough. So there was also a clear lack of control surrounding the financial software being used here. There should never be an option to override vendor data or manipulate check information subsequent to the any payments being made. So this is especially true if the system has mitigating controls or has restrictions on this as a part of its software package. And that is, from my experience, typically the case in the more recent and reputable software packages. So also noted in this case, the board was not following the appropriate regulations of the state. This lack of oversight could easily have come up in a state compliance audit, and proper review and approval should be in place as required. Similarly then to the case of Dixon, Illinois, expense line items in the budget should be monitored appropriately and reasonable expectations should be set in the budget from the start. All right, so the next case we'll review, this occurred in the Grandview School District in Missouri. So this case involves the school's trusted business manager who embezzled almost $1.6 million over the span of 10 years. With the money she stole, she was able to buy a second home, multiple Harley-Davidson motorcycles, and also a new Corvette. She also purchased high-end appliances to furnish her second home through the use of the school district's credit card. This, like the other cases I've gone over, was a situation where the business manager was blindly trusted and loved by everyone. Even after the fraud was initially uncovered and she was placed on leave, and as the investigation continued, the community members accused the superintendent and the school board of, quote unquote, harming one of the most important people in the district. They stated that she was a beloved member of their small community and that the board had no reason to believe that she would steal from the town's children. So this unquestioned trust, along with a lack of internal controls, gave the business manager the opportunity that she needed to steal from the district. So how was the business manager able to get away with this fraud scheme? A forensic investigation had revealed that transactions that had been hidden, and they were done so by forging of records throughout the district's financial and record-keeping processes. So these forged records included pay stubs, invoices, purchase orders, contracts, bank statements, and even IRS forms. So unlike the former cases we discussed, a lot of time and effort was actually put into making sure this went undetected. The manipulation of the records was definitely thorough and extensive. So this business manager took the time to cut up statements and then photocopy them to make them look like they were paid to legitimate vendors, opposed to paying them directly to herself. She also tried to conceal her embezzlement by inflating the reported wages of other employees of the school district. So in doing that, this caused those employees to pay excess income taxes around $13,000 to the IRS that they did not actually owe. She also inflated her own salary in certain cases, which is what eventually led to her getting caught. Her fraud scheme then was finally unraveled when the superintendent was copied on an email to the business manager from the Missouri School Employee Retirement System. So a representative from the state system had asked the business manager why her reported retirement salary was $28,000 more than her reported base salary, which understandably seemed odd to the superintendent. So the superintendent chose to follow up on the matter by further investigating on his own. In doing so, he found out that her salary, as well as the salaries of several other employees, had been incorrectly reported over the span of multiple years. He also then found that she had multiple letters of assignment that had been forged in her file, and they all showed different pay amounts. So this likely could have been used as support for the overstated pay she was using, just in case there was anyone that would have questioned it. Once caught, then the business manager was sentenced to 63 months in prison after pleading guilty of mail fraud. And she also was required to pay back over $1.8 million to the district in restitution. So as noted before, the main reason she was able to embezzle so much money over the course of the 10 years was a lack of significant controls within the financial department of the district. She was essentially trusted with all of the key responsibilities that she needed to manipulate the system. She had the duties of the business manager, the board secretary, human resources manager, and also the payroll coordinator. And all of these duties she had accumulated over the course of her 20-year career by convincing the school district that she could be trusted and respected. Now, typically an organization wouldn't have one single person that is involved in every aspect of the payroll process. Grandview, however, is a rural school district with only around 825 students and was not able or wealthy enough to employ a large administrative and financial staff. So because of financial shortfalls, the students there were forced to use decades-old laptops, the preschool wasn't funded, and teacher salaries were frozen or their positions were cut altogether. So the fact to them that the business manager showed interest in taking on more responsibilities, it was regarded as showing initiative, not necessarily as plotting deception to steal from the district and taxpayers, when in reality she was stealing hundreds of thousands of dollars. So really just keeping that heightened level of awareness there. So since the fraud was discovered, the district has strengthened its system of checks and balances by spreading out the former business manager's duties across several staff members, and then requiring additional verification of expenditures by multiple people. And they also hired someone to supervise each of these duties. All right, so all of these were good examples of what the district should have had in place from the beginning. You're probably seeing a trend here that too much trust in individuals was the main cause of these cases. So Again, having a heightened level of professional skepticism and being able to identify the red flags, such as the business manager living beyond her means while the school was struggling, should really have raised questions by colleagues in the board. Segregation of duties was also a clear issue here. Even in offices with a small staff, which may likely be the case in a lot of the small townships and authorities, an allocation of duties should always be established, even if it requires involving the board. So in this case, the business manager was also the payroll coordinator and was able to manipulate employee salaries, falsify records, and prepare the reconciliations. And there also did not appear to be any detailed review of the work she was performing, so it allowed her to get away with it as long as she did. All right, so the next case we're going to review involves not only a former PA Township utility supervisor, but also her husband, who was a former township officer. So over the course of a decade, this employee was found to embezzle over $850,000 from South Whitehall Township. So although this is the known figure, it is suspected that she and her spouse had stolen even more, as the financial records maintained at the township only went back to 1999, and that's where they could see the embezzlement had started. So similar to other cases, the township employee involved in the fraud scheme was well trusted and had been with the government entity for more than 30 years. Excuse me. Unlike some of the more simplistic schemes mentioned previously, the supervisor had established a much more sophisticated lapping scheme to avoid getting caught, and that was by using the residents' bill payments to cover the money she was stealing. So what I mean by a lapping scheme, essentially when one resident paid a utilities bill with cash at the township building, the money was not deposited to the township bank account, nor was it credited to the resident's account. Instead, the money was pocketed by the supervisor. Then if the next resident paid a bill by check, the check would be credited to the previously mentioned resident's account and deposited into the bank. If a third resident paid their invoice with a check, that check would be credited to the second person's account, and then she would continue this trend, just using one payment to cover another, but ultimately just pocketing the cash payments there. She also used other methods to avoid getting caught, such as pulling invoices to avoid detection that certain residents' accounts had not been credited. So at the end of the billing period, any customer that had not been covered by a subsequent customer's payments, she would just pull those invoices from the system. And this all goes back to another situation where there was a clear lack of segregation of duties. So the supervisor had exclusive control over the billings and payments that the township residents made for water, sewer, and recycling services. And she was also responsible for processing all payments and bank deposits, adjusting and crediting the customer accounts, and then was responsible for handling all residents' complaints, which she likely didn't share with anyone else in the township. In addition, she reconciled the cash drawer daily with no other review of the checks and cash received. So now clearly, like we discussed earlier, there are areas of higher risk and areas that give an employee a greater opportunity to commit fraud. And one of those areas, of course, would be cash collections and cash on hand. So it's clear that the opportunity was available for them to commit this fraud from the sheer lack of internal controls in place. It's noted that the supervisor and her husband also lived beyond their means and were in a total of over $100,000 in gambling debt. So this is a clear pressure for them to seek out the opportunity to commit the fraud, if we're going back to the fraud triangle we discussed earlier. The supervisor was then finally caught when the township finance director at the time retired and the new director came in and suspected something fishy was going on. So under the new finance director's advisement, the township hired a CPA firm to do a forensic accounting investigation, and that resulted in the discovery of the decade-long fraud. All right, so what could have been done to prevent Whitehall's fraud? So keeping with the trend, there was a blatant lack of segregation of duties within the utilities department at the township. So processes should have been implemented to verify and review the checks and cash received at the township building. In addition, only one person controlled the entire billing process for large commercial customers, which even allowed her to manipulate the meter readings on the bills. Lockboxes and other physical controls should also be put in place if large amounts of cash and checks are collected on site, and duties for bill collection and processing should be split between multiple people. For example, meter readings should be performed and reviewed by someone different than those inputting and processing the bills. Deposits should be made and reviewed by someone different than those collecting and processing the payments. Further review of actual bills and longstanding balances should be reviewed by either a finance director or by the board. So if reports were adequately reviewed from the system, this may have shown the large outstanding balances for the customer accounts that had not been covered in the lapping scheme. Requiring employees to take vacations is another way to potentially detect fraud, as it forces other employees to pick up their duties. Okay, and then the final case that we'll go over here is similar to the last in that it involved the pressure of financial hardships from gambling and a lapping scheme. So this case occurred in the city of Placentia, California. Hopefully I'm pronouncing that wrong, or I'm sorry, right? But this is where the financial service manager embezzled more than $5 million over the course of just 2 years. So very short in comparison to some of the other fraud schemes. And also the person involved was not necessarily someone that had a long standing with the governmental entity or someone that was well liked or trusted. So this may have attributed to the reason that the fraud was uncovered sooner than the rest of the ones that we discussed. So to start with the pressures that attributed to committing the fraud, the manager unfortunately had put a lot of money in bad investments and gambling. He was also trying to help his parents get out of nearly $700,000 in debt. And an opportunity was then given to him to commit the fraud when he was able to take advantage of turnover in the city's finance department. So due to a lack of supervision and review of duties, the interim manager, was able to send a number of unauthorized wire transfers amounting to the $5 million to various private bank accounts. Then to conceal the fraud, the manager manipulated bank statements and the city's general ledger within the accounting software. He was eventually caught then when employees at the Westgate Las Vegas Resort and Casino were suspicious when an individual aiding him in the laundering of the embezzled money tried to persuade the casino to accept a wire transfer from the city of Placentia, which he allegedly had claimed was for a film project. So I'll be honest, maybe not the brightest fraudsters here, as that seems like a bit of a stretch, but either way, the casino employees then tipped off city officials who started an investigation at the city finance department. The manager then fully admitted to his crimes and was charged with multiple felonies and 25 years in prison, and agreed to pay back up to $10 million in fines and then around $2.5 million in restitution. So about double of what he had even stolen from the city. So what could have been done to prevent this fraud? Along with the various measures mentioned in other cases, proper planning during a time of turnover should have been put in place. So this could include an overall contingency plan implemented by the city that would have shifted roles and responsibilities if a main employee is out, while ensuring there is still separate review in place. In addition, there should be procedures in place for the proper authorization of wire transfers or checks over a certain amount. So most online banking or any banking in general has controls that can be activated in which a different person than the one initiating the transfer has to log in and approve or accept a wire transfer being made. And then for the checks, an organization could require multiple signatures on checks over a certain amount, and then obviously proper board approval of expenses. So all of these are examples of what may have aided in preventing such a large fraud scheme at this city. And then that's actually all I have for you for the presentation today. I'll go over a little bit about SEK, the firm that I work for, and then open it up to any questions in the last few minutes here, if there are any. So
yeah, you might want to check your chat box.
Oh, okay. Sorry about that. You pull that over here. Go through the questions now. Okay. So the first question states, I am a township treasurer and and the second signature after the township manager. When the checks are approved to be sent at a board of supervisors meeting, it is always after audit. What actually is done week to week for auditing? Is there something that I can do as I review the checks when I add my signature, the second one? So I want to make sure I'm understanding, I guess, this question. If by after audit, you're saying that these invoices were already reviewed, I'm assuming that's what that's referring to. If that's the case, I mean, again, just ensuring that these checks are legitimate, I would think that they weren't being cashed until your signature is in place. So if anything is kind of highlighted as suspicious, I would bring that up again once they're signed. I may not be understanding the question there, so please stop me. Or we can add another chat then if I didn't answer your question. Another question, where can we view all the Queen's Horses film? I believe that is available on YouTube actually. So it's a pretty large documentary, but it definitely goes into all the details of that fraud scheme. And what is the difference between an audit and a forensic audit? So an audit, which is what I do, we are really coming in to ensure that the financial statements of the entity are not materially misstated. So that doesn't mean that it would be due to fraudulent activity. It could have been done to error or the likes of that. So we're not performing any type of fraud investigation. Again, sometimes we will ask employees if they're aware or suspicious of any fraud, but it is not our purpose to come in and specifically look for fraudulent activity. We are really just there to make sure that the financial statements are not materially misstated. Next question, how can we check if vendors are legitimate and proper payments are made and there is not collusion between staff and vendor to commit fraud? So that can be a little tricky. As I mentioned, collusion obviously makes it more difficult, specifically if there are multiple people involved. And in this case, you're referencing the vendor as well. So I would say, again, just focusing on the budgeted amounts, reviewing transactions for legitimacy, even just logically, do these transactions make sense? I actually had a client one time, and it didn't come to the point that we thought it was fraud, but there were multiple payments for the same amount, very large dollar amounts that related to the same invoice number. And that would typically, I mean, that definitely caught our attention that these multiple payments were being made to the same invoice number. So I would focus on invoice number, recurring numbers, recurring amounts for the same amount within the same time period there. Also, I mean, just a quick check on vendors would be a search in the address on an invoice or a phone number of that sort. Next question, is there a process that requires a periodic PA state compliance audit? As a borough supervisor, we may not know what we don't know, and a state audit could uncover any problem. So I can't speak specifically to the state audits. I work for an independent CPA firm where we're coming in and doing a financial audit, but I will say that we do specific compliance audits, which you had mentioned, and that's typically if your entity would receive a certain dollar threshold in funding. So either over a certain dollar threshold in state funding or federal funding. So for example, if you have over $750,000 of federal funding in a year, you would be required to have a compliance audit. A single audit is what it's known as. So I'm going through these kind of quickly because I realize we're out of time. Is it very expensive to have an auditor periodically review the processes? Well, that would depend on what audit firm and the processes that you're going through. Contracts can be put together if it's just like an AUP, like certain procedures that we're coming in on. It would be different than the actual financial statement audit that I had mentioned that we come in for annually. But again, typically that would just depend on the extent of the procedures that you want reviewed. And then the last question we have here, and again, sorry, I realize it's 101, would conducting a forensic audit by an outside firm identify not only fraud, but the lack of controls in an organization? So I personally don't do forensic audits, but I could assume that yes, in identifying the fraud, it would show the lack of controls into how that fraud was able to be conceived. So I can't guarantee that as a part of the process, they are presenting an opinion on your internal controls, but I think in determining the fraud, it would definitely show a hole in any internal control processes. So I apologize. I realized I was going through questions really quick there. If there's any others, my email address should be provided on the PowerPoint, and you can reach out to me directly on that if that is the case, or if I didn't answer a question that you had asked and would like to reach out to me specifically, you're welcome to do that as well.